Gold. Let's bring in Richard Clarida, perfect guest to have today, head of global strategy, PIMCO, for years with Columbia University. This is exciting. What a jobs report. Bizarre is how Michael Darda called it. I like that. Was it bizarre?
We thought there would be a weather-related impact, but to get the combination of a very disappointing payroll number with a 0.4 decline in the unemployment rate, and from the divergence with the household survey, yeah, that was an outlier.
Audible, we're not doing dreaded first chart here now. Forget about dreaded first chart. Bring up the weather chart.
Oh, yeah.
I didn't believe Bloomberg had this chart. Can you bring up the weather chart? They're working on it right now. There it is. Bad weather. Stay home. It's an Audible. Look at this chart. Back to 1980. Yeah. That's a number of people, 800,000. Way over there on the right side is that spike up. 1996 was grim in the middle. They even canceled classes at Columbia.
I remember 1996.
Do you? What happened?
Well, my second child, Russell, was on the way, and we were sort of nervous about that. Yeah, that was quite a blizzard.
Was he born in a snowdrift?
No. It was a couple weeks later.
Yeah. But anyways, there's the chart. This is remarkable. So you just, let me guess, you take everything to a moving average and you worry about 90-day statistics.
Well, you do some of that, but no, look, there are a lot of signs in the economy. Whether or not you look at the ISM prints, we have a surprise index that we follow. That's certainly showing a lot of positive surprises. The economy clearly has momentum from Q4 into Q1 with the stimulus from QE2 and the fiscal package.
Is it transitory or is there a permanence to it? Is QE2 going to be just like housing? Yay, housing. Oops, it went away. Collapse. What happens when QE2 goes away?
That's the $64 billion question, and that's one that I and a lot of economists are focused on right now. I mean, Q1 does look very strong. The question is, as we move into 2012, does the economy taper back to 2% growth, or does it really get escape velocity up to 4% growth?
We need to make news here. What's your call?
I think that we revert back down into the twos in the second half of the year. So I'm from Missouri on this. I hope I'm wrong. I hope we have a robust recovery.
Break exclusive, Clarida on the edge of new normal. Let's bring up a dreaded chart here, the new labor economy. And we're going to bring up the new labor. There it is, the new labor economy. Dreaded first chart, labor participation. Yeah. Richard Clarida, you teach this in Econ 101. Yeah. By definition, that's not a good sign, is it?
No, it's not a good sign. And the real challenge right now, Tom, is how much of this is due to the cycle and how much of this is really a longer-term secular decline in labor force participation. And that's going to be key for the Fed, because if these numbers stay low, then that means that the amount of economic growth we get will be held back by a slower labor force.
Let me bring up chart 2, Rex. Bring it up here. Median duration, another structural view here, far away from 2008. Okay, economists can rationalize. Here's a length of unemployment, median duration. I guess there's a turnaround, but we're still a long way back. 9.0% unemployment. Do you readjust your unemployment rate call at PIMCO?
Well, you know, I looked at some research by the San Francisco Fed recently, quite good. I'm sure you've seen the study, where they publish a range of estimates for the NIRU, the so-called non-accelerating unemployment rate. If you go back 3 years ago, they were very tightly bunched around 5.2%. Now they're all over the place. Some models see it at 5, some see it at 8. I think clearly the Fed knows there's excess capacity at 9. The question is, as we move into this recovery, it becomes a tougher call.
Well, I'm glad you brought up NIRU. This is we're going to do this in 1 minute here. This is way too much for Super Bowl Friday. Bring this up here. NIRU is distant. CBO, NIRU, minus the unemployment rate. This is from, I can't remember where I got this. Michael Darda. I think Michael Darda put this up in his note out about half an hour ago. So you take your 7 or 6% number and you subtract unemployment. We're in the tank, aren't we?
Absolutely. And I think the chairman in his speech this week, or actually I should say his Q&A at the National Press Club, actually made that point in the prepared remarks, that yes, the Fed is buoyed by the fact that growth is picking up, but there's still substantial excess capacity in the labor market, excess slack in the labor market.
You're an expert on the German economy, the European economy. Should the chairman have a press conference like President Trichet after the Fed meeting?
Well, this is, I think, the second or third one that he's done. I would certainly think that would be a good idea. I don't know if he wants to lock his schedule into every meeting, but I think having regular press conferences is effective, and I think the chairman was very effective yesterday.
Richard Clarida with us from PIMCO, of course, for years, Dean of Columbia University's Economics Department. Tom Porcelli with us from RBC Capital Markets. Tom Porcelli, I want you to comment on a jobs report today. And I guess the end result is there's some glimmer here. Bonds move on the report. What was so optimistic in the report?
The truth is, I don't think that you can make really anything in this report one way or the other. If you're looking at the plus 50, I would tell you that that plus 50 should probably be dismissed. What we've seen over recent months is that that number has been prone to higher revisions. And if you're looking at that 9% on the unemployment rate, I would argue that it's not a completely fair number. It was impacted by what was going on with some population adjustments. So it's not giving us a clean read of what's happening with the labor conditions, this report in particular. Right. But what I would say is that if you look at some high-frequency macro data, it's not consistent with the idea that we're growing jobs at only a plus 50. So I would say, you have to be sort of cautious with this report.
I want to look at a bigger view here, Richard Clarida and Tom Porcelli. Earlier this morning on Bloomberg Surveillance, I spoke with Jim Glassman of J.P. Morgan, and I asked him about the role of education in a recovering job economy.
Education, fine. It's no guarantee of a good job. A lack of education may be a guarantee of disaster, but the truth is education really, it's helpful, and that's why the education community is working very hard to try to figure out how to modernize the education system.
Jim Glassman, Richard Clarida, everyone's writing about this. It's almost like it's lip service to education. What would you like to see to jumpstart that large part of America that's really not participating in this recovery?
Well, excellent question, and I think right now the thing to jumpstart the recovery is the momentum in the economy and the policy that's in place. So the education reforms are crucial longer term to growth and productivity, but I think realistically any forms that we put in place today really have payoffs many years down the road.
I mean, and Tom, I want to talk to you about housing in our next block, but this idea of just a nuance here of part-time versus full-time. Bring up the chart, if you would, here, of part-time people who would rather be full-time. Jim Glassman bringing this to my attention this morning. Glassman's kids aren't all right, playing off the great business we cover out yesterday. What a shocking chart, Tom Porcelli. 3 million up to 4 million, and then we explode to 9 million part-time workers. Have we become a part-time nation?
I mean, I think the unfortunate fact is there are just not a lot of jobs out there for people, so they'll take what they can get. We're looking to maintain some level of semblance in terms of consumption growth, and if that means working part-time, even if it's as a second job, I think what the data show is that people are clearly willing to do it.
I mean, we got Richard Clarida, this video here that we're running of, people with real jobs, manufacturing. Manufacturing is positive today. Is part of the PIMCO new normal that manufacturing works up, even if it is with a weaker dollar?
Well, yeah, manufacturing has benefited from what's a strong recovery in the emerging world, and on balance what has been a weaker dollar, although some ups and downs. I think the real key, though, is that manufacturing success has been because it's been very productive. And productivity is good for profits, it's good for your export share, but it's not necessarily going to translate into employment in manufacturing commensurate with the output growth.
I want to bring up. Yeah, go ahead, Tom. Nope, please jump in.
Yeah, I was just going to say. I mean, to that point, I think it's a great point. What we've seen in this report, and again, this probably was impacted by the weather, was hours fall to some extent. But there's actually room for improvement on hours. So if companies can actually continue to add to hours, then that means that they're less likely, or they might be less likely, to add to headcount, particularly if we remain in a very modest growth environment.
Tom, what do we need for non-farm payrolls to feel better? 200,000, 300,000?
Yeah, it's a good question. The one thing I would say, and you and I spoke about this very recently, is, what's feel better? I mean, define that for me, because even with an unemployment rate at, around 9.5%, you're still able to grow consumption, around 3 or 4%. So what's feel better? Do you need us to be back towards 6%, which is roughly where we should be at this stage of the recovery, or is 3% enough?
Okay, I want to bring up too much information here, folks. Richard Clarida, this is to your camp. And this is almost like on the edge of Dale Jorgensen here of Harvard. An efficient, productive America. I just took real GDP and I divide it by the number of employed, which is sort of a cool chart, and it shows that immense productivity out there. Inflation adjusted, we've gone from 60,000 to 90, from 60,000 to 90,000 per employed worker. And granted, it's spiked up here. Does the new productivity diminish or enhance job growth?
Well,
and if you say it depends what time, short term or long term, right?
I was about to say that. You read my mind. I've been on your show too many times. Yeah. In the long term, it's going to be neutral for job growth and great for wages and standard of living. But in the short term, it can be a negative, and we've been seeing that in the data.
I mean, Tom Porcelli, you really see this here. I mean, things are more productive, but then where are the jobs if we have this great productivity?
Well, I think productivity is part of the reason why we don't need so many jobs, right? I mean, we're in a slow growth environment. Final sales are moving along at an okay clip. I would sort of be dismissive of that last number. It's obviously not going to be repeated. But I think in a low growth environment, you don't necessarily need to add to headcount because you're getting enough out of current workforce with current productivity means.
Week after week, Business Week does it with emotion. The kids are not all right. Tom's too young to remember the great Who song. Unfortunately, you and I
I remember I used to play it in a high school rock band.
Really,
so,
TV, right?
Yeah, absolutely.
Yeah, with a capo because we couldn't sing like Roger Daltrey. But here it is. It's a great cover by Peter Coy. Must read, and it's tragic, and it's really your international global space. It's a global story, isn't it? It's not just about Egypt.
Well, absolutely not. No, it is a global story, and it really is a story of the G10 economies. Really divergence there with some commodity exporters on one path, Canada, Australia, the rest of Europe in another path. And then, of course, the emerging world. And that's really the reality of the foreseeable future, really three worlds. The emerging world, the sort of the G10, and then the parts of the G10 that are commodity exporters.
I want to squeeze you in here for the last minutes we've got with you. Your work on currencies. Yeah. You say people should be in currencies at PIMCO. It's a smart research paper you've done. Here's trade-weighted major broad index down to record lows. I mean, so much for Rubin's strong dollar policy. Down we go. How does PIMCO recommend my viewers make money in currency?
Well, I mean, it's an important allocation for a lot of investors. It's really based on some academic work that I and others have done that shows that on a risk-adjusted basis, there are returning currencies. And the key is to do the risk adjustment and to make sure that you are appropriately factoring in the risk. So they're not for everybody, but they make sense in a lot of portfolios.
Bring up this research note right now, if you would. Rex, come on, Rex. Forget about the Super Bowl. Let's go. The foundation of housing has many cracks. There's a high likelihood that ultimately many folks will become renters. This dynamic should keep home prices under pressure. Tom, you put a negative 6% statistic on this. That's pretty ugly, isn't it?
You know, it is pretty ugly, and the truth is it could actually get much worse. One of the things we did in this note was we said, okay, let's assume that all of the shadow inventory actually makes its way into the system. Now, of course, that would never happen, but we just sort of wanted to get a sense for where the market clearing price on homes would be. Home prices would actually fall another 40% if all of the shadow inventory made its way into the market. So, again, that's a worst-case scenario that we don't see playing out, but, again, it's indicative of where prices actually should fall, just to clear.
Yeah, Neil Sasa, Credit Suisse, wrote up a lovely piece today on mortgage demand and mortgage supply. It's really not too perky in the latest data, is it?
No, it's not. And, again, this note that we put out shows that it's not even just a question of demand. Consumers clearly have very little demand for homes, but lending standards remain still remarkably tight. So, housing has a long way to go. And the one thing that I've continued to say to clients is, look, we recently raised our GDP estimates by 1 full percentage point, but we didn't touch housing. Housing is going to continue to be a drag on economic activity over the course of the year.
We got a Bill Gross note coming up. But first, this chart, Tom, I get so many emails which essentially say, would you stop talking Wall Street mumbo jumbo and talk about the retirees out there? Here it is, folks. It's a 3-year CD rate adjusted for inflation. And, Tom, we're back down to a zero real rate, aren't we, on savers' money?
No, I think we are. And we were just talking about this on our desk here. It's, at what rate is actually going to bring people back into the market? And even think about 10-year yields. 10-year yields are 3.5%. Is that enough to really entice buyers? The fact is, at this point, the biggest buyer of U.S. Treasuries is the U.S. government. It's the U.S. Federal Reserve.
Well, that distorts a 2-10 spread. Is a 2-10 spread a good indicator now? Or, boy, is this jargon-laced? I am so jargon-laced on Friday. It's my excitement over the Steelers and the Packers. But Tom, is a 2-10 a legitimate indicator of market action?
No, I think it is. It's one of the inputs into our recession model, as an example. So I think it does have some value, and I would not be dismissive of it outright.
Let's bring up the Bill Gross note here. Richard Clarida's colleague out in Newport Beach. This is an important note. Go to PIMCO's site and read this note by Bill Gross. It's our note of the day, Devil's Bargain. They are robbing savers and taking money surreptitiously, I hope I spelled that right, from longer-term asset holders who are incorrectly measuring future inflation. Tom, this is the crux of the matter. The greedy banks like RBC are taking money out of savers' hands, right?
No, not at all. We are not greedy bankers.
You're Canadian. It's a difference.
I would say that it's true that rates are still stunningly low, and I think to the point on inflation, I think that we should probably brace for slightly higher inflationary impulse than some people think. And again, this is a topic that you and I spoke about just very recently. From our perspective, you are starting to see some pass-through, and it's actually starting to gain some traction. So, here we are at 1% on core measures of inflation. I don't think anyone should be surprised if we're closer to 2% by the end of this year.
Where will the 10-year yield be a year from now?
It'll be north of 4%. If you wanted to pinpoint north of 4, yeah. If you wanted to pinpoint an exact number, call it 4.3%.
I don't know what it means for savers. We'll find out. Tom Porcelli, thank you so much. RBC Capital Markets and